Ever wondered how the stock market works and how you can make it work for you? Picture this, a bustling marketplace, but instead of fruits, vegetables, or clothes, it's stocks and bonds that are up for grabs. This is the stock market, a complex yet fascinating world where shares of publicly traded companies are bought and sold. At its core, the stock market operates on a simple principle: supply and demand. When a company decides to go public, it sells shares of its ownership, known as stocks, to the public. If the company's prospects look bright, more people want to buy its stocks, pushing the price up. Conversely, if the company hits a rough patch, demand for its stocks falls, and so does the price. This constant ebb and flow of buying and selling, of highs and lows, is what makes the stock market a vital part of the global economy. It serves as a barometer of economic health, reflecting the collective optimism or pessimism of investors worldwide. But the stock market isn't just for the Wall Street moguls or the financial whizzes. It offers opportunities for everyone, including you, to grow your wealth. How so, you ask? Well, when you buy a company's stock, you're essentially buying a piece of that company, a stake in its future. If the company does well, so do you. Your stocks increase in value and you stand to make a profit when you sell them. Of course, it's not all smooth sailing. The stock market can be volatile, with prices fluctuating wildly in response to various factors. But with careful research, informed decisions, and a pinch of patience, you can navigate these choppy waters and turn them to your advantage. So whether you're looking to save for retirement, fund your child's education, or simply grow your wealth, the stock market can be a powerful tool in your financial arsenal. Understanding the stock market is the first step to becoming an investor. And we're here to help you take that first step. So buckle up and let's dive right in. So, you're ready to buy your first stock, but how exactly do you do that? The journey to buying your first stock is like a treasure hunt, filled with countless possibilities and excitement. But before you dive in, it's essential to understand the process. First things first, you'll need a brokerage account. Think of this as your gateway to the stock market. This is where you'll be buying, selling, and holding your stocks. There are numerous online brokerage accounts available today, offering a range of services and tools to help you make informed investment decisions. Once you have your brokerage account set up, it's time to identify the stock you want to buy. This is where your research and analysis come in. Look at the company's financials. Read up on their business model, understand their competitive landscape, and consider their future growth prospects. Now, on to the exciting part, buying the stock. When you've identified the stock you want to buy, you'll come across terms like bid price and ask price. The bid price is the highest price that a buyer is willing to pay for a stock. The ask price, on the other hand, is the lowest price that a seller is willing to accept. The difference between these two is called the spread. When you're ready to buy, you'll place a market order or a limit order. A market order is an order to buy or sell a stock at the best available price, whereas a limit order allows you to specify the maximum price you're willing to pay for a stock. Once your order is executed, voila! You are now a proud owner of a piece of the company. Remember, investing is not about quick wins, but about long-term growth. So be patient, stay informed, and let your money work for you. The process might seem a bit intimidating at first, but like anything else, practice makes perfect. And remember, every investor started somewhere. With the right approach, buying stocks can be a straightforward process. You've bought some stocks, and now you're wondering when and how to sell them. Well, let's dive into the process of selling stocks. Selling stocks isn't as simple as hitting a sell button. It's a process that involves several steps. First, you need to place a sell order with your broker. This involves deciding how many shares you want to sell and at what price. This price is known as the ask price, and it's the lowest price you're willing to accept for your shares. Now, there are different types of sell orders that you can place. A market order is when you sell your stocks at the best available price in the market at that moment. On the other hand, a limit order allows you to set a specific price at which you want your stocks to be sold. However, there's no guarantee that the market will reach this price. Another type of sell order is the stop order, also known as a stop-loss order. This helps limit your losses by setting a price at which your stocks will be sold automatically if the market price falls to that level. It's a great tool for managing risk, but like a limit order, there's no guarantee that it will be executed if the market doesn't reach your stop price. So when should you sell your stocks? That's the million-dollar question. There's no one-size-fits-all answer, but here are a few tips. You might consider selling if the company's fundamentals have changed for the worse, or if the stock has reached a price target that you've set. Alternatively, you might want to sell if the stock has become overvalued, or if you need to rebalance your portfolio. Remember, the goal is not just to make profits, but also to manage risk and maintain a balanced portfolio. In conclusion, selling stocks involves careful decision-making and a good understanding of the different types of sell orders. It's not just about making profits, but also about managing risk and maintaining a balanced portfolio. Knowing when and how to sell your stocks can help you secure your profits and limit your losses. Buying and selling stocks might seem simple, but there are some key points you need to keep in mind. Firstly, it's pivotal to do your homework. Research is the cornerstone of smart investing. You should understand not just the company you're investing in, but also the industry, market trends, and the financials. Now you might be thinking, but hey, I've found this one company that's a surefire success. Well, that brings us to our next point, diversification. It's crucial not to put all your eggs in one basket. Spreading your investments across various sectors and companies can help cushion against losses in any one area. Another key point is to invest for the long term. While it's tempting to ride the wave of market highs and lows, successful investing is often about patience and consistency. Think of it as a marathon, not a sprint. Let's talk about selling. It's easy to get swept away in the frenzy of a soaring stock or panic at the first sign of a dip. But remember, smart investing isn't about emotional reactions, it's about strategic decisions. Have a clear exit strategy for each stock in your portfolio and stick to it. On the flip side, buying stocks isn't just about jumping on the bandwagon of the latest hot tip. Consider the company's fundamentals, its growth potential, and whether it fits into your overall investment strategy. And finally, never stop learning. The stock market is dynamic and ever-evolving. Staying informed and adaptable is key to navigating its ebbs and flows. So, read widely, stay curious, and don't be afraid to ask questions. To wrap up, remember that investing isn't a get-rich-quick scheme. It's a commitment to growing your wealth over time. So, do your research, diversify your portfolio, be patient, have clear buy and sell strategies, and stay informed. Remember, smart investing is about more than just buying low and selling high. What does the future hold for the stock market? Well, peering into the crystal ball of the financial world, we can discern a few potential trends and developments. One significant trend is the rise of sustainable investing. Investors are becoming increasingly conscious of the impact their investments have on the world. More and more, they are seeking out companies that prioritize environmental, social, and governance factors, also known as ESG. This shift in investor preferences is likely to reshape the stock market, pushing companies to become more sustainable and responsible in their operations. At the same time, technological advancements are fundamentally altering the way we invest. We're seeing the democratization of the stock market, with easy-to-use trading apps bringing investing to the masses. Artificial intelligence and machine learning are also becoming increasingly important, providing investors with sophisticated tools for predicting market trends and managing risk. Blockchain technology, too, is poised to revolutionize the stock market. It could streamline the trading process, increase transparency, and reduce fraud. We might even see the rise of tokenized stocks, which could make investing even more accessible and efficient. Moreover, the global economy is becoming more interconnected, and this trend is likely to continue. This means that events in one part of the world can have ripple effects throughout the stock market. Investors will need to become more globally aware, keeping an eye on international news and developments. Finally, as the world grapples with challenges such as climate change and income inequality, the stock market will play a crucial role. Companies that can provide solutions to these issues may see their stocks soar, while those that fail to adapt may lag behind. So what does this all mean for you, the investor? It means you'll need to stay informed, adaptable, and forward-thinking. You'll need to understand not just the companies you're investing in, but also the larger trends shaping the market. The future of the stock market is exciting, and being part of it can be a rewarding journey.